G'day taxpayers, back on terra firma after that flight, and it gave me a chance to have a look at the national accounts in great detail while I was on the plane, enjoying the stale chicken sandwich, but I saw nothing redeeming in those national accounts figures, the GDP figures that were released earlier this morning, that showed quarterly growth of 0.2%. Oh dear, that's not good. Annual GDP, 1.3%. Oh dear, that's not good either. That's absolutely miserable. And I was thinking to myself, why is the economy so weak? There's got to be a reason. There has to be. I looked at government demand. While there was a little bit of a pullback in the March quarter in government demand, it has been strong. We've heard lots of discussion that the government spending as a share of GDP is at or near a record high. The government's got to get its budget back into order, all this sort of stuff. So you can't blame the government for this weak GDP result. It ain't the case. In fact, on the contrary, if it wasn't for the government, we would have a absolutely and utterly miserable economy right now. I looked at the world economy, and it's really been in the last, couple of months that the Liberation Day tariffs have been impacting on the economy. Prior to that, the world economy was doing okay. It's only really been the last few months that we've had these downward revisions from the OECD and the IMF to the global economic outlook. So the world economy is not the reason why we've got this rotten rate of economic growth. I then looked at the Aussie dollar. Sometimes an overvalued currency puts a constraint on your local economy, and the fact that we've been in the low 60-cent region, around about 60 points on the trade-weighted index, we've actually got a really competitive exchange rate. We're doing reasonably well on the international trade balance. We've got a smallish surplus there, so we're actually doing okay. So it's not the currency. And it led me to think, well, what is the reason then? If it's none of the above, well, what is it? And I think the answer is pretty simple. It's the Reserve Bank. It's the level of interest rates that have been above restrictive, that word that the RBA likes to use, for the best part of 2.5 years now. So for 2.5 years, the level of interest rates has imparted downward pressure on spending, on investment, on inflation. And that is the sole reason it appears that the economy is so weak. If you've got 2.5 years where interest rates are acting as a restraint on economic activity, which they have been, no wonder the economy is weak. And no wonder the inflation's back on target. No wonder GDP growth's struggling to get much above 1% in annual terms. So it says to me, and I look back at what happened in 2023, they overhiked interest rates. 2024, too slow to cut. And even though they've delivered two piddling 25-point cuts in February and again just last month, they paused in April. They didn't go 50 last month when they should have. And so we're sitting here and looking at these national accounts numbers in concert with the inflation indicators, in concert with the global economic outlook, and we're seeing a picture where we've got to get that official cash rate, monetary policy, back to at least neutral, a level of interest rate that's neither stimulating nor restricting the economy. And indeed, given the momentum of the economy, if we get another figure like this next quarter, we need to actually have accommodative interest rates. So what's that mean? Getting rid of that economic jargon and claptrap? It means a cash rate at least 75 basis points lower than we have today, probably 100 to 125 points lower if we need stimulatory policy. So that will evolve in the next couple of months. But we do need to see the RBA cutting 50 at the July meeting, playing a little bit of catch up for its errors previously, getting the cash rate down to the 3.35-ish%, giving the economy a chance to sort of get a breather, to grow a bit. The Reserve Bank have been wedded to its inaccurate, unhelpful economic models, and they haven't really been looking at the real economy terribly closely. Even though the governor said that data dependent, we will react to news as it comes out, they haven't really reacted to the inflation numbers. They haven't reacted to the run of very poor economic activity indicators, and they haven't reacted to what's happening in the global economy. They're one of the tardiest central banks in terms of cutting interest rates in this cycle. So disappointing economic news, I'm afraid to say, but the solution, well, the easy one is for the RBA to aggressively move monetary policy to neutral and probably to accommodative, and it needs to get there sooner rather than later, else 2026 is going to be a really tough year for the economy. Over to you, RBA.